Let's start, just given what you mentioned, there was some news that came out in the 10Q this morning. It shows that Berkshire sold another 115 million shares of Apple in this last quarter. That's Berkshire's largest holding. And I think in that vein, we'll start with a question from Sherman Lamb. He is a 27-year-old Berkshire Hathaway Class B shareholder from Malaysia. And he asks, last year you mentioned Coca-Cola and American Express being Berkshire's two long-duration partial ownership positions, and you spent some time talking about the virtues of both these wonderful businesses in your recent shareholder letter. I noticed that you have excluded Apple from this group of businesses. Have you or your investment manager's views of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016?
No, I would. But we have sold shares, and I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have now. One interesting thing is that Charlie and I looked at common stocks or marketable equities or the things that people love to look at as being businesses. And so when we own a Dairy Queen or we own whatever it may be, we look at that as a business. And when we own Coca-Cola or American Express or Apple, we look at that as a business. Now, we can buy really wonderful companies in the market.
Now, you might be wondering why Warren Buffett, known for his long-term investments, would sell part of his stake in Apple, his largest holding. The truth is that Buffett is just preparing for what's coming. A storm is brewing in the stock market, and this move signals Buffett's caution. But how did we even get here? Well, as most of you might already know, Buffett treats stocks as businesses. In fact, he's focused on their long-term performance, which is why he still considers Apple a fantastic company. But despite his optimism, the Oracle of Omaha is slowly building up cash reserves. Think of it this way. When someone as steady as Buffett is taking protective measures like selling a portion of his most successful investment, it's a sign that turbulent times might be ahead. As if that's not all, Warren Buffett admits he can't predict the market for what's coming, so he's just practicing caution. But this next part is perhaps the most interesting.
We always look at every stock as a business, and we have no attempt made to predict markets. We have no attempt made to pick stocks. I went through many years doing the wrong thing. I got interested in stocks very early, and I was fascinated by them. And I wasn't wasting my time because I was reading every book possible and everything else. But finally, I picked up a copy of The Intelligent Investor in Lincoln, and there was a few sentences in there that said much more eloquently than I can say it. But if you look at stocks as a business and treat the market as something that doesn't tell you, isn't there to instruct you, but it's there to serve you, you'll do.
Here's the thing. Buffett doesn't bother trying to predict the stock market because he believes that's actually impossible. And in case you're not aware, his strategy focuses on owning strong businesses rather than timing the market. But despite his approach, Buffett is aware that unpredictable events can still disrupt even the best businesses. To paint a much clearer picture, the stock market is filled with short-term, unpredictable noise, and Buffett knows a storm may be coming that investors cannot predict. What's more, his message to ignore the daily chatter is a subtle warning to prepare for what's ahead, rather than react impulsively to every market reaction. Now let's take a closer look at Buffett's take on taxes hitting record highs.
And we are paying a 21% federal rate on the gains we're taking in Apple. And that that rate was 35% not that long ago, and it's been 52% in the past when I've been operating. And the government owns, the federal government owns a part of the earnings of the business we make. They don't own the assets, but they own a percentage of the earnings. And they can change that percentage any year. And the percentage that they've decreed currently is 21%. And I would say with the present fiscal policies, I think that something has to give. And I think that higher taxes are quite likely, and the government wants to take them.
Now, let me make this clear. Warren Buffett has seen higher taxes on the horizon, and he's not the least bit surprised. In fact, he's been through periods where tax rates were significantly higher than today's 21%. With the current fiscal policies, Buffett believes that rising taxes are inevitable, and that could send shockwaves through the market. And if you think that's troubling, wait until you hear this next part. Higher taxes could hit corporate profits, which in turn would affect stock prices and ultimately the broader market. Think of it this way. Buffett is preparing for a time when the government will take a bigger share of earnings, which could trigger market volatility. He's cautious for a reason. But what I'm going to reveal next is perhaps the most interesting part. Buffett's willingness to pay higher taxes is actually a signal of just how concerned he is about future fiscal policies affecting the market. Now here's the part where things really start to get troubling.
A greater share of your income or mine or Berkshire's, they can do it. And they may decide that someday they don't want the fiscal deficit to be this large because that has some important consequences, and they may not want to decrease spending a lot, and they may decide they'll take a larger percentage of what we earn, and we'll pay it. And we always hope at Berkshire to pay substantial federal income taxes. We think it's appropriate that a country that's been as generous to our owners. It's been the place. I was lucky. Berkshire was lucky it was here. And if we send in a check like we did last year, we sent in over $5 billion to the U.S. federal government. And if 800 other companies had done the same thing, no other person in the United States would have had to pay a dime of federal taxes, whether income taxes. No Social Security taxes, no estate taxes, no, it's up and down the line. Now, that's
I think we can all agree that this is more proof than Warren Buffett is preparing for what's to come. But perhaps the most fascinating part is just how he manages to keep calm when so many signs point to uncertainty. As it turns out, Buffett doesn't panic sell when things get rough. In fact, he always looks to buy more. Now, that might sound counterintuitive, but here's where it gets interesting. Buffett knows that the best time to buy a great business is when others are afraid. He looks at market dips as opportunities instead of catastrophe. What's more, some of the things he's doing, like building up Berkshire's cash reserves, reveal that he even knows a storm could be cooking in the stock market. And as we have already seen, he expects taxes to rise. That alone could shake investor confidence completely. Buffett is clearly preparing for future market conditions that could catch everyone else off guard, but he's ready to crush the oncoming storm. This next part is a true call for alarm.
So I would say that looking at our 70 businesses, and that actually, they represent hundreds in addition, they're a little softer. On the other hand, I was out with the fellows from the Nebraska Furniture Mart just Saturday night, and their business was up quite a bit in February, but that's because weather was good. So you have a lot of variables that hit.
Why do you think
business was down, let's say, the last 6 months? Is that a decline in confidence, or is it coming off of levels where there was unusual activity ahead of that?
Well, it isn't really down. It's just it leveled off and a little softer maybe now. But, well, tariffs. The tariff situation was a big question mark for all kinds of companies, and still is to some degree. But that was front and center for a while. Now coronavirus is front and center. Something else will be front and center 6 months from now, and a year from now, and 2 years from now. The real question is where are these businesses going to be 5 and 10 and 20 years from now? Some of them will do sensationally, some of them will disappear, and overall, I think America will do very well. It has since 1776.
But you still watch things like railcar loadings very closely.
I watch everything. But I don't do it to make specific investment decisions. But I enjoy it. I mean, I want to know what's going on. But I also don't think that I can make money by predicting what's going to go on next week or next month. I do think I can make money by predicting what's going to happen in 10 years.
All right, well, tell us more about what's going on, just since you like knowing about those things.
Well, as I say...
You see, Warren Buffett talks about the impact of tariffs and the coronavirus, but more importantly, he's signaling a bigger issue: constant change. Every 6 months, every 2 years, there's a new challenge on the horizon. First, it's tariffs, then it's the global pandemic, and soon it will be something else entirely. In fact, this unpredictability is exactly what Buffett wants us to understand about the economy and the markets. But here's the thing: while storms may come, the real question is not how you can survive the storm that's brewing, it's about where businesses will be in the long run. Buffett's message here is clear: brace yourself for the inevitable ups and downs, and keep your eyes on the bigger picture. What's happening today is just part of the journey, and the real measure of success is how businesses navigate these waves over time. But interest rates actually matter more than you might imagine. In the next section, we'll explain why.
Please ask him, what impact does the zero interest rate environment across places like Japan and Europe have on their banks, whether the business is still good, and does the prolonged low interest rate regime in the United States hurt the prospects of American banks like JP Morgan, etc.? And in such circumstances, do Indian banks, which have high return on equity, look attractive to Mr. Buffett?
Yeah, well, I can't comment on that latter, but generally speaking, with there are a lot of other variables too, but the banks are going to make more money if there are higher rates with a steeper curve. The curve is more important. In other words, the 10-year versus short-term rates may make more difference in the absolute level. But American banks have made very good money with very low interest rates. Around the world, if you look in the UK or Europe or Japan, even lower rates have made it pretty tough for banks. The returns on equity are not as high, and they have to use more leverage to even get the same returns, and I don't like that as well.
If you are talking about the curve that we're looking at this morning, the 5-year, 2-year is inverted. 2-year 10 is not right now, but the 10-year is below 1.4% this morning.
And think of it, the 10-year at 1.4%, that means you're paying 70 times earnings for something that can't increase its earnings for 10 years.
Okay,
now, if somebody came to you with a stock and said, this is a terrific stock, it sells at 70 times earnings, the earnings can't go up for 10 years. You'd say, well, explain that to me again.
Right.
But no, we've never seen a situation like that.
Now let me make this clear. Buffett thinks low interest rates is a real issue, especially for banks. In fact, he explains that banks make better profits when interest rates are higher, when there's a steeper yield curve. But here's where it gets tricky. Prolonged low rates, like the ones we've been seeing in places like Japan and Europe, are creating uncertainty. Even the brightest economists can't fully predict what this means for the future, but it's far from positive. Think of it this way: prolonged low interest rates can lead to bigger financial issues that we don't yet understand. What's more, they could spark a series of unexpected challenges for the entire banking sector, creating the perfect storm for future instability. As if that's not enough, Buffett thinks interest rates are the real foundation for value. Here's why.
It is not a normal situation, and it's Well, interest rates are the basis of all value. I mean, if you knew interest rates were going to be zero for 100 years, you would think 1% was a great rate of return. But you also would know if you bought something that was yielding 1%, or that was what it paid, and rates went to 8%, you'd lose practically all your capital. So it's an enormous factor, and we don't know the answer. Central banks don't know the answer. All we know is that it's been useful in stimulating things, and particularly asset prices, now for 10 years. And what we thought was temporary in 2008 and 9 in the way of monetary policy to stimulate, we've just put our foot on the gas even further. The whole world has.
You made a point in the letter of saying that you don't know how long these interest rates will last. Yep. You and Charlie never try and figure these things out. But we did have St. Louis Fed President Jim Bullard on the program last week, and he said that he expects to see these low interest rates for a long time to come. That does raise a lot of questions, if that happens, about what this means for the stock market, what that means for banks, what that means for insurance companies, which you touched on in the letter too.
It's bad for insurance companies.
The thing is, interest rates are just the groundwork of everything. Or at least that's how Warren Buffett sees it. He stresses just how crucial these rates are when it comes to determining the value of assets. What's even more concerning is the fact that no one, not even the best economists, knows what will happen next with these historically low or even negative interest rates. And in case you're not aware, interest rates drive asset prices. For more than a decade now, these low rates have been stimulating markets, inflating asset prices. But what happens when this stimulus is removed? The truth is, no one can say for sure. The uncertainty around interest rates is like a ticking time bomb, just waiting to reshape the market when it goes off. And when it does, the fallout could be significant. But why does the risk appetite of investors truly matter when it comes to reaching for yield?
If you need to get 3% and you're only getting 1%, the answer is to quit giving 3%. It's not to try and get the 1 up to 3 and do more dangerous things. You should always adapt your consumption to your income. You shouldn't try and adjust your income to your consumption. That's a basic principle for individuals, businesses, and everything else. And reaching for yield is really stupid, but it's very human. I mean, and I understand it. And people say, well, I've saved all this money all my life and now I can only get 1% out. What do I do? The answer is you learn to live on 1%, unfortunately. And you don't go and listen to some salesman come along and tell you, I've got some magic way to get you 5%.
Do you think, though, that's what should be happening? Do you think that there is more risk taking place in the insurance market as a result?
And you see that in what they call leveraged loans and weaker covenants. And all. No, people are reaching for yield. There's no question about that. And that's stupid. And it has consequences over time. But it's very human.
Consequences that could have a big market impact?
Depends how far it goes. Yeah. It's something that, things that get built in slowly, people going crazy in tech companies in the late 1990s, it can take a lot longer than you think. Mm-hmm. But eventually you get to midnight and everything turns to pumpkins and mice.
You know, that's the downside of low interest rates. Pensions, savers, anybody who gets left in a raw position of that. On the alternate side of things, if rates were to rise rapidly, or maybe not even so rapidly, what does that mean for the federal debt?
Well, it depends on the average maturity of the debt, but our maturities are fairly short. They've gotten lengthened a little. But if you take 20 trillion and you're borrowing at
Now, if there's one thing Buffett is adamant about, it's the dangers of reaching for yield. In his own words, it's stupid, though understandable. But let me explain why this is so important. In a low interest rate world, investors are taking on more risk to chase higher returns, and this could lead to some disastrous consequences moving forward. The problem is, people aren't adapting to the reality of lower returns. They're pushing their luck by taking on more and more risk. And if you think that's troubling, wait until you hear what happens when the market corrects itself. Those risks could come back to haunt investors in a big way, causing sudden downturns and widespread financial pain. So investors need to be more careful with risk. But this next part is probably the most exciting.
Perception on his part had experienced changing conditions, but people just looked. They got their confirmation through stock prices, and that's what happens in bull markets. People start out thinking stocks are cheap, and then they start thinking stocks have gone up. and a stock can be a good buy or a bad buy. A bond can be a good buy or a bad buy. It depends on price.
But that leads us to today. I mean, if his premise was that stocks are always going to be a better investment than bonds, that's kind of what you hear today, which...
It might surprise some, but Buffett isn't always bullish on stocks, especially when conditions are uncertain, such as what we have ahead of us. The Oracle of Omaha doesn't fall into a trap of believing that stocks are inherently better than bonds in every situation. When markets get particularly rough, bonds can serve as a safe harbor, something steady to anchor yourself to. And that's especially true now, with interest rates jumping all over the place, changing the investment landscape by the day. Buffett's critique reminds us that the game of investing is not a one-size-fits-all. There are times when the waves of the stock market might make a solid bond portfolio look far better. In a sense, you must be adaptable and recognize when to seek a gentle river over potentially choppier seas. And here's why you need to keep some profits in cash as the storm draws nearer.
He said if a stock yields 4% and a bond yields 4%, which was what he was talking about then, the stock was going to outperform the bonds because there were retained earnings that were building beyond that yield. And that has been true for a long, long time, but nobody paid any attention to it. We don't get rich on our dividends that we receive, although we're happy to receive them. We get rich on the fact that the retained earnings are used to build new earning power, repurchase shares, which increases your ownership in the company, and Berkshire is.
There's a reason Buffett places so much weight on history, especially when it comes to markets. Edgar Lawrence Smith's findings showed that companies with a strong foundation retained earnings. Essentially, profits that are reinvested into the business tend to endure market volatility better than others. Let me put this into simpler terms. Retained earnings are like a business's emergency fund. The more a company holds back and reinvests, the stronger and more flexible it becomes, able to adapt and grow even during impending storms. So, when Buffett talks about retained earnings, he's pointing to the core strength of a business. It's this financial resilience that separates the companies that thrive from those that barely survive during turbulent times, such as what he thinks is coming. More importantly, you need to stay adamant even as the whole world prepares for what's coming, and here's why.
People who are just waking up, they're tuning in and they want to know what you think about this sell-off this morning. To see the Dow down 700, 800 points in the morning, what's your reaction when you see something like that?
Well, my reaction is that I like to buy stocks, so I don't wish ill on anybody else, but I like to, if they want to sell them to me cheaper, I prefer it. So if that's a roughly a 3% decline or thereabouts, I don't know how many 3% declines I've had in my lifetime, but there have been a lot of them. And I can't think of one that you shouldn't have bought on, basically. That doesn't mean stocks are going to go up or down next week or next month or next year. But if there's something, if you like to own American businesses, you're getting a chance to buy it 3% cheaper. I don't consider that a lot cheaper. I mean, but how can it be bad news unless you have to sell stocks? Now, if you have to sell them for some reason, you're worse off. If you don't have to sell them, I mean, somebody can come around and offer you a quote on your house today, and it can be 2% less than they offered you yesterday. But if you like the house, it really doesn't make any difference to you.
Does that mean Berkshire will be buying stocks today?
Well, we certainly won't be.
Here's where Warren Buffett's calm demeanor really shines through. When asked about a market sell-off, where the Dow drops 700 to 800 points, he doesn't flinch. In fact, he sees it as a buying opportunity rather than a crisis. He's experienced plenty of 3% declines in his lifetime, and to him, it's just another day at the office. What's more, his reaction reflects his long-term strategy, one that doesn't get rattled by short-term volatility. Think of it this way. Buffett's calm during the storm serves as a reminder to all of us that market downturns aren't the end of the world. Sure, they're unsettling, but they're also a part of the natural cycle of investing. And if you keep your focus on the bigger picture, you'll find that these sell-offs can actually be opportunities in disguise. I think we can all agree that Buffett's insights are a stark reminder that while the market may be in flux, maintaining a long-term view can be the best strategy. Now, we've handpicked some videos that we think you'll find incredibly valuable as well. They're right here on your screen, so be sure to check them out. Thanks for watching.